You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And with me today, nationally recognized life expert, Bobby Samuelson, and we're talking about guaranteed universal life. A lot of carriers are leaving the business. We'll talk to Bobby about all that.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and of course we're broadcasting live from Fountain Hills, Arizona, home of America's largest fountain, to a nationwide network of financial advisors. And with me today, as yesterday, Bobby Samuelson. Welcome, Bobby.
Great to be here.
All this week we're talking about life insurance. Whole life yesterday, GUL today. Guaranteed universal life. Everybody jumped into this from year 2000 to 2010. Everybody was playing in this space. The decline of interest rates hurt a lot of carriers. We've seen a major exodus from this space. And yet, I've also seen people dig in and say, we're staying here, we're here for the long haul. Let's talk a little bit about the mechanics and why some are leaving and why some are staying, and I'm not sure they should stay.
I'm not either. That's a great way to tee it up. Yeah, so I think one thing we ought to throw off the table immediately is that the companies who are in it know something that the companies who are getting out don't. All right, so what I'm saying is there's no secret sauce. And so really, I had a panel discussion at the Forum 400, which is a big industry meeting, and I had 4 actuaries on the panel, and one of the things I asked is, some of them had left No-Lapse Guarantee, and some of them were retrenching. And when you get down to it, it's really just a question about philosophy. And the guys who are getting out philosophically say, we don't want to be in this business, and here's why: low interest rates, a lot of other things too we can talk about if you want to. And then the companies who are in it say, no, we think the consumer value is there, we think we can do it, and we're willing to stick around and see where this business goes over the next 10 years. So like I said, there's no secret sauce. In my opinion, it really comes down to a philosophical decision and how well the carrier has built a pivot product. So some carriers feel like they have to sell No-Lapse Guarantee because they don't have an alternative.
Well, that's true. I mean, if you don't have indexed UL in your portfolio to pivot to, or even some players who still believe in the FINRA market when doing VUL, I mean, you're really stuck. Now let's talk about that interest rate, because I think that is so important. I want to make sure our producers understand why we're even bringing this up.
Interest rates.
Yeah, interest rates, because really we're all fishing out of the same debenture pool.
Yeah. Okay, so great question. And I don't think people were asking this question, by the way, a lot until the 2000s. So basically, I think the primary point on interest rates is that when you write a No-Lapse Guarantee contract, you are writing a long-term liability that you owe your policyholders. So what you're doing is you're basically saying, I'm giving you a guaranteed premium and a guaranteed death benefit, and that's going to create guaranteed returns inside of the policy. And so I'm going to price that with, let's say, a 5% assumption across the board for returns. And if interest rates are 7%, that's great, because if interest rates go up, do you discount the premium payments to the clients? No, keep it the same. So you're still giving them their 5% rate of return, but now you're earning 7%. But when interest rates fall below what you've given policyholders, essentially, now you have a problem. And there's all sorts of accounting issues that come into this. So U.S. companies don't have to recognize that problem as quickly as Canadian and European companies do. That's why you see Canadian and European companies getting out faster generally than U.S. companies. And so I think the primary thing to think about is, look, this is a swap. This is an interest rate swap. The insurance company's giving you a rate of return, and they've got to earn more than that rate of return to make sure it's profitable. And the problem is, in No-Lapse Guarantee, they gave out and are still giving out rates of return that are dramatically higher than Treasury rates right now. And the difference between the Treasury rates and the No-Lapse Guarantee product is real, tangible liability to the carrier.
Can they make this up with cost of insurance?
No, because remember...
that's it. See, this is the argument. Yeah, this is the argument.
Yeah, so remember, premiums are guaranteed, and those premiums are based off of guaranteed cost of insurance charges inside the shadow account, which is, again, another discussion point. So then there's no parameters that can change. I mean, the difference between this and long-term debt is really just cosmetic. I mean, at the end of the day, they issued a rate of return, and they're going to pay it to you. So it's the same as if you'd issued a bond on your balance sheet. You can't go back and change the coupons and can't go back and change that stuff. Similarly, you can't go back and change the premium payments on a No-Lapse Guarantee. So the only way that they can make this product work is on the asset side. All right. Now, if policyholders lapse their policies or things like that, then you can start to make up some of the difference. But if everybody holds their policy to maturity, you're stuck with what you wrote, and there's nothing you can do about it.
Well, I have been in this thing, and we went through 3 CSOs in my career. I don't even know if we'll ever hold it to maturity. But I mean, it could happen, and I understand the mechanics of that and the long-term liability. Speak a little bit about this, because there's two formulas that people use in our public discussion. And when I write blogs and articles, I use the term secondary guarantees.
Yeah.
The higher end actuaries use the word shadow accounts.
Yeah.
Same or different?
Same.
Okay.
But as my wife's best friend from Vietnam says, same but different, right? So the secondary guarantee is a provision that basically, think of it more as a contractual provision that basically says, look, you pay this premium, you get this death benefit based on what you've illustrated here. So the idea is that there is a guarantee inside the contract, and there's lots of different ways you can build that guarantee. But the idea is pay a premium, get a death benefit. Shadow accounts are a particular way of building the guarantee. So shadow accounts basically give the carrier a lot of flexibility in pricing. And what they do is they essentially operate identically to a current assumption product, where they have policy charges, they have interest credits, and when you pay in premiums, loads come out. And so basically it's this notional account. It's not real dollars. It's just kind of digits inside the carrier's ledgers. And again, guaranteed charges, guaranteed costs. I mean, guaranteed charges, guaranteed interest, whatever else. So when you pay a premium in and you get your guaranteed premium, the carrier didn't kind of divine a guaranteed premium they thought was right for that cell or for that payment period, 10 pay, 5 pay, whatever. What they did was just build one shadow account, and then whatever premium that shadow account kicks out is the premium you owe, but that premium is estimated based on the shadow account parameters. The alternative is much more simple, which is where you have a cumulative premium test, which is basically pay this premium, and as long as you paid X amount in at this point, you get a guarantee. Shadow accounts are much more complicated. If you miss a premium on a cumulative premium product, you have a catch-up provision, right? If you miss a premium on a shadow account, you have to deal with the shadow account policy charges and all sorts of other complex stuff behind the scenes. And the real risk is that shadow accounts are very complicated.
Well, I just saw the New York actuaries a couple weeks ago griping about no reserves for these accounts.
That's another
and we're going to
issue.
get into that. When we come back, I want to talk about the no reserves. Does this have anything to do with triple X and triple E? I think it does.
Yes.
We'll talk about all this. You're listening to Bobby Samuelson, one of the top life experts in the United States. Remember, you can watch our show on www.brokersalliance.com. You can write us at the show, thebiz@brokersalliance.com, and call us 1-800-290-7226. We'll be back with more from Bobby right after the break.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Helping people with their finances is a great responsibility. Taking care of the families you serve requires more than just providing protection. It means helping them take smart steps towards building a successful future. A good first step is offering the Ultra Index, a low-cost life insurance product that accumulates cash values your clients can access for emergencies, college tuition, or additional retirement income. That's the Ultra Index from Lincoln Benefit Life, an Allstate company.
Well, welcome back to the Business Insurance Zone. I am Steve Savant, your host, and with me, of course, all this week, Bobby Samuelson. Bobby, we're talking about shadow accounts, secondary guarantees, the New York actuaries griping about the reserves. Does this tie back to Triple X? I don't want to monologue the rest of the thing for you, but really I think I've set the table, because everybody's asking about this, and I don't think anybody explains it to the regular producer. So give us a little introduction into this.
Yeah, so I'll try to make it as simple as possible, because it is a very, very complex issue. Again, just to recap real quick, shadow accounts are a particular methodology for determining premium. All right, so they create the shadow accounts, they guarantee them, they put them in the products, and then depending on how you pay your premiums, it's going to interact with the shadow account just like an estimated premium on a current assumption product. Exact same thing, except the difference is you have guaranteed charges, guaranteed interest credits in the shadow account. Can't see it, it's somewhere inside the ledger, right? So the issue is, the reason why shadow accounts are so important is because not only do they impact how the policy performs over the long run, so again, if you miss a premium or don't pay a premium on time or whatever, that's going to be impacted by how the shadow account is structured, but also because the shadow account impacts how the carrier reserves for the product. So basically there's this 9-step formula, AXXX, AG38, depending on whatever you want to call it, and that 9-step formula essentially calculates the additional reserves that a carrier needs to hold for writing a no-lapse guarantee product. And the shadow account structure is going to determine that, and so I'm trying to make this simple, but basically the idea is that there is a way that what carriers have done is basically tweak the shadow account structures to hold less reserves. Some carriers more than others, and the way they've done that is actually by building additional cost curves inside the product, no disclosure to the client, but I've seen cases where clients have been paying $150,000 a year, accidentally triggered one of these extra cost curves the carriers were using to reduce their reserves, and the client has to pay $700,000 out of pocket to fix it.
On a guaranteed universal.
On a guaranteed UL.
How can that be?
Because in the contract, the other costs are guaranteed in there, but they have triggers, right? So if your shadow account value falls below this, or if you miss a premium payment here, you're going to jump from one charge to another charge. Now, they did this to reduce reserves.
Well, I get the reason. I don't want to reserve any more than anybody else if I was in their balance sheet issue.
Absolutely.
But I'm telling you, I think our producers are sitting there hearing this and saying, wait a minute. You got guaranteed universal life contracts out there that could trigger an event where the client would have to pay more.
Yeah.
And we've been saying all along what? Guaranteed premium to endow.
Yeah, I think this is actually emblematic of a much larger issue, which is people say guaranteed premium, guaranteed death benefit, no risk. No. There's a lot of risk in no-lapse guarantee contracts. This is one risk, and this risk will play itself out for a very small number of policyholders. But the reality is, and you know this, clients don't pay premiums on time. Clients miss premium payments. These are long-dated contracts, and anytime you do that, you may interact with all these other cost curves.
Now, you also said, though, in the first segment, and we have several carriers that give a catch-up provision for this, but they charge interest on top of it.
That's on a cumulative premium product. There is no catch-up provision on a shadow account product.
Okay.
That's right, because the catch-up is determined by the shadow account. So there's no provision per se. There is just the shadow account, and if your shadow account value drops low, you got to pay enough to refund it. So that's the issue.
Well, Bobby, I'm telling you, we could do a lightning show on who is in trouble on this issue. I mean, I don't know of anybody. And I'll say this, and if you want to write me, thebiz@brokersalliance.com. If you've knew this, and I didn't know this part, that it could actually trigger and cause. I knew it could trigger it, but I thought they were going to absorb it. Now you're telling me the client's going to absorb the premium. Is that what I heard?
Yeah, and carriers, carriers have settled out of court on this one. They've had lawsuits on it. There's all sorts of stuff. So every carrier has a method for handling it. And some carriers, by the way, have bigger problems with this. Some have little problems with this. And a lot of the companies that have been kind of in the news about this, they're the ones who obviously were relying on this to reduce their reserves and to give cheaper premiums to the policyholders. So the trade-off is, look, if they didn't do this, premiums across the board on no-lapse guarantee products would be higher. But since they are doing it, the premiums can be lower because the reserves are lower, but there's also more risk inside the product. So that's, again, to go back to the main point, no-lapse guarantee is not riskless.
So the New York actuaries that are griping about this right now, a couple weeks ago, they had an article all over the web. They're meeting together saying you're not reserving enough for this, you're not parking enough money, of course, and I always thought that was just New York State banter on they're always opposing everything that non-New York actuaries do, but no, maybe there's something to it.
Well, okay, so there's an issue, which is, look, the 9-step calculation prescribes a set of a reserve that you need to hold. What the insurance companies, and perhaps rightly, are saying is that's too much. That's over the economic real liabilities for these contracts. So I think the real problem is you got the letter of the law, which says one thing, and the carriers clearly have devised ways to bend the letter to get lower reserves. No question about that. And any company that says that that's what they did, every company is now willing to admit this. But what I think they're actually coming back and saying is, look, the letter of the law is too much on the reserves. It's just too much. And so what New York is actually going to do is they're going to prospectively say follow the letter of the law. Retrospectively, for all the policies that are in force, they're going to say, okay, we're going to do an adequacy test to figure out if your reserves are actually adequate, and we're going to do that not with the letter of the law, but with stochastic testing and all sorts of other things that go into this. But again, the real impact for producers is simply this: if reserves are higher going forward, no-lapse guarantee premiums are going to go up. But also, you probably won't have to deal with these two-tier cost issues. But again, broader point is, look, no-lapse guarantee is not riskless. Okay, you don't have any cash value, so you can't exchange it if something happens. If missing premium payments, you can get heavily penalized for that. So there's a lot of risk that you don't see in the. Remember, the illustration is pay your premium every year, everything happens perfectly. The real world is not perfect, right? So no cash value, big penalties for missing premiums. Not only that, we all think interest rates are going up in the next 10 years.
I've been saying it for the last 3.
Exactly, right. So everybody thinks that. So if you think that, this is the one product on the market that will not respond in a rising interest rate environment. So why is it that advisors are out there selling no-lapse guarantee in a low interest rate environment and saying, yeah, this is what you absolutely ought to do? When interest rates go up, this is the one product that won't respond that way. So I think more than anything else, producers should take a hard look at no-lapse guarantee and say, look, I've been selling this for the last 10 years, head over heels. But going forward, is this the right product for me to be pushing?
Well, Bobby, you just put the fear of God and everybody just up their errors and omissions insurance. That's the Buzz on the Biz for today. You've been listening to Bobby Samuelson. I'm Steve Savant. We'll see you tomorrow.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.